Why does investing $500 monthly feel pointless for the first decade, then suddenly explode into life-changing wealth? While financial educators promise that compound interest is the eighth wonder of the world, most people experience years of frustration watching their investments barely grow despite consistent contributions. Here's what investment advice rarely mentions honestly. Compound growth requires decades of favorable market conditions that aren't guaranteed, and the psychological challenge of staying invested during flat early years defeats most people before acceleration begins. Over the next few minutes, I'll reveal 7 principles explaining compound psychology with a realistic assessment of both the mathematical potential and significant limitations. The 4th principle shows why Warren Buffett made 99% of his wealth after age 50. Though individual results vary dramatically based on market conditions and timing. If you want honest compound interest education without promotional promises, subscribe and comment patient growth below. But that's just the beginning. What I'm about to reveal shows why the snowball's deceptive beginning explains both the power and the patience required for compound wealth building. 1. Why compounding feels slow initially. You start investing consistently, month after month, year after year, and after 5 years, you look at your account balance feeling completely discouraged. Despite your discipline and sacrifice, the numbers barely look different from when you started. You're contributing $400 monthly, but your account shows maybe $25,000 total, and you think, at this rate, I'll never have enough to retire. The progress feels so slow that you start questioning whether investing actually works. This frustration causes many people to abandon their investment plans just when consistency matters most. You see others talking about compound interest as if it's magical, but your personal experience feels like watching paint dry. Let me tell you about 2 people trying to build snowballs on a winter day. The frustrated roller expected to create a massive snowball immediately and kept starting over when the first few pushes didn't produce dramatic results. Every time the snowball looked small, he'd abandon it and start fresh somewhere else, never building any real momentum. The patient accumulator understood that snow needs minimal mass before it can gather more snow efficiently. He kept pushing the same small snowball even when progress felt invisible. Initially, both snowballs looked identical, but after persistent rolling, the patient accumulator's snowball suddenly began gathering exponentially more snow with each rotation. Mathematical reality shows why early investment years feel unproductive. Compound growth creates most wealth in the final years of a long timeline. However, this assumes favorable market conditions that don't always occur, and individual results vary dramatically based on timing and economic circumstances. Here's something realistic you can try. Instead of obsessing over account balances during early years, track your contribution consistency and treat that as your primary success metric. Focus on what you can control, regular investing, rather than what you can't control, market performance. The mindset shift you need is understanding that early investment years create a foundation rather than results. However, be realistic about compound growth requiring decades of favorable market conditions that aren't guaranteed. The snowball metaphor illustrates mathematical principles, but real investing includes significant risks, market downturns, and economic uncertainties that can disrupt even consistent investment plans. Don't let simplified metaphors create unrealistic expectations about guaranteed outcomes. 2. Rule of 72 and doubling periods. You hear about the magic of compound interest and expect to see meaningful results within a few years of consistent investing. Maybe you've been putting money away for 3 or 4 years, and you're frustrated that your portfolio hasn't grown enough to feel significant. You start wondering if you're doing something wrong, or if compound growth is just another financial myth that doesn't apply to regular people with modest investment amounts. This impatience leads many investors to constantly switch strategies, chase higher returns, or abandon long-term investing altogether, because the early results don't match their expectations. Let me tell you about two farmers who approached their orchards completely differently. The impatient planter expected apple trees to produce substantial fruit within 2 or 3 years of planting. When his young trees only produced small, sparse harvests, he'd get frustrated and replant with different varieties, convinced he'd chosen the wrong approach. He never gave any trees enough time to reach full production capacity. The season-wise cultivator understood that fruit trees require roughly a decade to mature before producing meaningful harvests. He planted his orchard knowing the first several years would show minimal results, but he cared for the trees consistently because he understood the timeline involved. After 10 years, his mature trees produced abundant harvests, while the impatient planter was still starting over with saplings. The rule of 72 illustrates this timing principle mathematically. Divide 72 by your expected return rate to see how long money takes to double. At 7% growth, investments double approximately every 10 years. This explains why early investing years feel unproductive. You're watching single digits grow rather than seeing dramatic multiplication. Here's something practical. When evaluating investment progress, use 10-year milestones rather than annual reviews. Track whether you're consistently contributing rather than obsessing over short-term balance fluctuations. The mindset shift you need is accepting that investment timelines operate on decades, not years. However, it's crucial to understand that the rule of 72 assumes consistent market performance that doesn't always occur. Market downturns can extend doubling periods significantly, and there's no guarantee that historical returns will continue. Economic conditions, inflation, and market volatility can disrupt even the most disciplined investment plans. Use these mathematical concepts as general guidelines rather than guaranteed predictions. 3. Two buckets approach. When you're focused on maximizing investment returns, it's tempting to put every available dollar into growth investments. You see your emergency fund sitting in savings earning minimal interest, while your investment account could potentially grow at 7 to 10% annually. This logic leads many people to invest money they might need for emergencies, creating a dangerous situation where market downturns force them to sell investments at a loss just when they need cash most. This all-in approach seems mathematically optimal until life happens. Job loss, medical expenses, or major repairs coincide with a market crash. Suddenly, you're selling investments at 30% losses to cover immediate needs, destroying years of compound growth potential. Let me tell you about two military engineers designing fortress defenses. The single-wall castle builder concentrated all resources into one massive, impressive wall, believing maximum strength in one area provided optimal protection. His fortress looked formidable and used resources efficiently, but when enemies found ways to breach that single defense, the entire stronghold fell quickly. The layered defense architect built multiple protective systems: outer walls, inner keeps, supply reserves, and escape routes. His approach looked less impressive because resources were spread across different functions. But when attackers breached the outer defenses, multiple backup systems kept the fortress operational and allowed strategic responses. The solution is maintaining two distinct buckets: growth investments for long-term wealth building and liquid emergency reserves for immediate needs. This prevents forced liquidation of investments during market downturns when you need cash for actual emergencies. Here's a practical implementation. Before increasing investment contributions, build 3-6 months of expenses in high-yield savings accounts. Only invest money you won't need for at least 5 to 10 years. When emergencies arise, use savings rather than touching investments. The mindset shift needed is viewing emergency funds as investment protection rather than missed opportunities. However, determining an appropriate emergency fund size depends heavily on individual circumstances, including job stability, family obligations, and health considerations. Market downturns can last years, and having liquid reserves prevents the devastating cycle of selling investments at losses during exactly the wrong times. This strategy assumes you have sufficient income to build both emergency funds and investment accounts, which isn't realistic for everyone facing basic financial challenges. 4. 5% contribution increases. Most people set up their investment contributions once and never adjust them, thinking that consistency means keeping the exact same dollar amount forever. You start investing $300 monthly in your 20s, and you're still contributing $300 monthly in your 40s, even though your income has doubled and inflation has reduced your purchasing power. Meanwhile, you're missing opportunities to accelerate wealth building during your peak earning years because your investment strategy is frozen at the entry level. This set it and forget it approach feels responsible because you're being consistent, but it actually limits compound growth potential. Your financial capacity evolves over time, but your investment contributions remain static regardless of career progression or income increases. Let me tell you about two business owners who manage their operations completely differently. The static operator bought basic mill equipment when starting his business and never upgraded or expanded capacity, regardless of how much the grain supply increased or how profitable operations became. His approach felt consistent and conservative, but his production remained limited by that initial setup throughout his entire career. The systematic upgrader gradually increased mill capacity as his grain supply and revenue grew. When business improved, he'd reinvest profits into better equipment and expanded operations. This meant less immediate profit in good years, but his production capacity grew exponentially while the static operators remained unchanged. The solution is building systematic contribution increases into your investment plan rather than maintaining flat dollar amounts indefinitely. However, this strategy assumes your income will grow consistently over time, which isn't guaranteed due to economic downturns, career changes, or industry disruptions. Here's something practical you can implement. If you receive annual raises, automatically increase your investment contributions by 1 to 2% of that increase. This approach is less aggressive than the original 5% boost, promoted in some frameworks, but more sustainable for most people's actual circumstances. The mindset shift needed is to view investment contributions as scalable rather than fixed. However, be realistic about income growth assumptions. Economic conditions, career setbacks, and family obligations can limit your ability to increase contributions consistently. Don't feel inadequate if circumstances prevent systematic increases. Maintaining consistent contributions during challenging periods is still valuable. This strategy works best for people with stable, growing incomes and shouldn't create financial stress or compromise essential expenses. 5. 10-year minimum timeline. The hardest part about long-term investing isn't picking the right funds or timing the market. It's sticking with your plan when progress feels invisibly slow for years. You might invest consistently for 5 or 6 years and still feel like you're nowhere near your financial goals. The account balance looks modest compared to what you think you need, and you start wondering if you should try something more aggressive or just give up on investing altogether. This impatience leads many people to constantly switch investment strategies, chase trending assets, or abandon systematic investing because the early results don't feel meaningful. You're essentially resetting your progress every time you change approaches. Let me tell you about two students pursuing advanced knowledge in completely different ways. The course-hopping student switched subjects whenever progress felt slow or challenging. He'd study economics for 2 years, then switch to computer science, then try business, always convinced that faster progress was possible in a different field. His scattered efforts meant he never developed deep expertise in anything. The disciplined scholar is committed to a decade-long mastery in one field, despite daily progress being invisible. She understood that expertise accumulates gradually, and that switching fields would waste years of foundation building. After 10 years, she had developed genuine mastery, while the course hopper was still a beginner in multiple areas. Compound growth works similarly. Most wealth accumulation happens in the later years, after a long flat period where you're building a foundation rather than seeing dramatic results. However, this assumes favorable market conditions over decades that aren't guaranteed. Here's something realistic you can implement. Instead of constantly evaluating investment performance, set up automatic contributions and only review your strategy during major life changes. Treat investing like a long-term educational commitment rather than a get-rich strategy. The mindset shift needed is accepting that meaningful wealth building typically requires decades of consistent investing during both favorable and unfavorable market conditions. However, be honest about the uncertainty involved. Markets can remain flat or negative for extended periods, and there's no guarantee that patience will always be rewarded with positive returns. This commitment strategy assumes you have a stable income and won't need the invested money for emergencies, which isn't realistic for everyone facing financial instability. 6. Avoiding fees and silent killers. You focus intensely on finding investments with the highest potential returns, but you barely pay attention to the fees and costs that are quietly eating away at your growth every year. A 2% management fee doesn't sound significant when you're hoping for 8% returns, but those seemingly small costs compound against you just as powerfully as your investments compound for you. Over decades, high fees can eliminate nearly half of your potential wealth. This fee blindness keeps many investors choosing expensive actively managed funds or financial advisors with high costs, thinking they're getting superior service that justifies the price. Meanwhile, the math shows that these costs often destroy more value than any additional performance provides. Let me tell you about two merchants who approach their business expenses completely differently. The luxury spender focused on impressive operations and premium services, regardless of their impact on profit margins. He hired expensive consultants, used fancy equipment, and maintained lavish offices because he believed these investments projected success and attracted better opportunities. His business looked impressive to outsiders. The margin protector carefully evaluated every business expense, asking whether each cost genuinely improved results or just created the appearance of sophistication. He used functional equipment, reasonable services, and kept overhead low so that more of his revenue could compound into business growth rather than being consumed by unnecessary expenses. The solution is systematically minimizing investment fees through low-cost index funds and ETFs, rather than expensive actively managed funds or high-fee advisory services. However, this assumes you're comfortable managing investments independently, rather than paying for professional guidance. Here's something practical you can research. Compare the expense ratios of your current investments with low-cost alternatives. Even reducing fees from 1.5% to 0.5% annually can add tens of thousands to your long-term wealth. Though this requires understanding which low-cost options match your risk tolerance and goals. The mindset shift needed is to treat investment costs as compound growth killers rather than necessary expenses. However, some people genuinely benefit from professional financial advice despite higher costs, especially during complex situations involving taxes, estate planning, or major life transitions. This cost-focused approach assumes you have the knowledge and discipline to manage investments independently. Individual circumstances vary regarding the value of professional guidance versus self-directed investing, and the optimal choice depends on your expertise, available time, and comfort with financial complexity. 7. Protecting capital from emotional decisions. Market downturns trigger intense psychological pressure to do something with your investments, even when the rational response is often doing nothing. When your portfolio drops 25% during a recession, every instinct screams to sell before losing more money. You watch financial news showing red numbers and panicked experts, and staying invested feels like standing in a burning building while someone tells you to remain calm. This emotional reaction destroys compound growth because most people end up selling near market bottoms and buying back when prices recover, essentially guaranteeing losses. Research consistently shows that average investors underperform their own investments due to poorly timed buying and selling decisions. Let me tell you about two military commanders facing extended campaigns with uncertain outcomes. The reactive commander made strategic decisions based on immediate battlefield conditions and enemy movements. When situations looked dangerous, he'd retreat to protect his forces. When opportunities appeared, he'd advance aggressively. His responses felt appropriate in each moment, but created inconsistent results over time. The steady strategist maintained a long-term perspective despite short-term setbacks and victories. He knew that temporary losses were part of achieving larger objectives, and that emotional reactions during crisis moments usually led to poor decisions. His approach looked reckless during scary periods but proved more effective across multiple campaigns. The solution involves accepting that market volatility is the psychological price you pay for potential long-term growth, not a problem to solve through timing decisions. However, this assumes you have appropriate risk tolerance and time horizon for equity investing. Here's something practical to consider. If market volatility causes you to lose sleep or constantly check account balances, you might have more risk exposure than you can psychologically handle. Consider reducing your stock allocation to a level that feels manageable during downturns, even if it means lower expected returns. The mindset shift needed is understanding that volatility is normal market behavior rather than something to avoid or solve. However, markets can remain down for years, and there's no guarantee that patient investing will always be rewarded. Individual circumstances regarding risk tolerance, time horizon, and financial stability should guide decisions more than abstract principles about staying invested. Some people genuinely need more conservative investment approaches due to their personal situation, risk tolerance, or proximity to needing the money, and that's perfectly reasonable. These 7 principles demonstrate how compound growth works mathematically, but require honest assessment about both the potential and significant limitations involved. Building substantial wealth through compound investing typically requires decades of favorable market conditions that aren't guaranteed, and individual results vary dramatically based on timing, economic circumstances, and personal financial capacity. The mathematical concepts are sound, but markets include prolonged downturns that can disrupt even disciplined investment plans. Success depends heavily on factors beyond personal control, including economic cycles, inflation, and market volatility that can extend timelines significantly. Most importantly, avoid branded investment frameworks that promise specific outcomes. Focus on sustainable investing habits that align with your actual circumstances, rather than following promotional formulas that oversimplify complex market realities. Remember that investment success requires both mathematical understanding and realistic expectations about uncertainty and risk. What's your realistic approach to long-term investing, given current market uncertainties and your personal financial situation? Share your balanced perspective below and subscribe for more honest financial education that prioritizes both wealth-building potential and individual well-being over promotional promises.